So as you can sort of probably see my title slide up, which says more speed bumps ahead. In the economy, we do expect 2023 to be a slower year compared to what we saw in terms of growth overall, both in terms of job market as well as economic activity in 2022 and in 2021. Just a sort of a quick overview of what I will be presenting this morning. So I'm going to give you a quick run through and then actually go through the details on each of these bullet points. So first of all, we're seeing signs of slowing mounting in the Texas economy. This is not just true for Texas, but it's also true nationally, where we see job growth. It still remains really robust, but it has come down from its feverish pace that we saw in 2021 and in the first half of 2022. We are seeing some other indicators of economic activity, such as manufacturing, new orders, activity in the service sector began to slowly decelerate. So they are still growing, but the pace of growth certainly has decelerated in the last 6 months of 2022, coming into 2023. We're seeing some pullback in consumption, although it still remains quite strong overall. And then any interest rate sensitive sectors such as housing, commercial real estate, and lending overall is being impacted by higher interest rates. There are still some strengths that I will talk about and allude to during my presentation, and these include the labor market, which is a huge deal because only if people have jobs will they then spend in the economy and buy houses or buy groceries or pay their rent. So that side of the economy is still holding up relatively well. For Texas, this matters more so than nationally, and that's the energy sector. And we are seeing still really good growth in energy sector activity because of where oil prices are at. Now, they're not at $100. They've come down to in the mid-70s, but that still bodes well for us. But there are many risks to the outlook, and I have outlined them in these bullet points, which includes, potential U.S. recessions, which a lot of economists and analysts are calling for this year, perhaps a mild and brief recession sometime in mid-2023. We already are seeing a slower pace of growth globally. If we look at many of the indicators such as GDP growth and as well as employment, inflation numbers are looking a little bit better, but it still remain quite elevated. And rising interest rates obviously are a damper to economic growth, because they do pull back economic activity as the cost of capital rises. And then we are still seeing persistent labor constraints in the market, and higher wages. So even though job growth still remains strong, we still are hearing from many firms across the state that labor still remains a challenge. So this is now kind of turning to some of the visualizations I've put together for the presentation this morning. This chart plots the employment growth for Texas. The solid blue line, which has that big sort of downward drop in the early part of 2022, shows you the actual path that employment has taken over the course of the last 12 years. The line that is sort of running straight right above it, and it's a dotted line. I'm not sure if y'all can see the dots really well or not. Probably not in this format. But that straight line that runs up is telling you if the recession in Texas had not occurred in 2020, if we had not been hit by COVID, if we had not had the pandemic, this is where employment in Texas would be. And so it's basically a projection saying, barring the recession that we saw occur in 2020, here's where employment in Texas should have been at the end of 2022. Now you can see Texas has pretty much fully recovered in terms of the jobs that were lost in March and April of 2020. Those jobs have been fully recovered. In fact, we've added a lot more jobs since then. But in terms of our potential growth, we're still shy of that, and will likely make it to our potential at some point in 2023 if all stays well and we do not see a US recession. Oops, I think I switched the mode. Sorry. There we go. This chart is now plotting Texas employment growth and U.S. employment growth by major sectors. So they are these sectors where we look closely at on an overall basis. These are classified by the North American Classification Association, and they sort of come up with these broad industry categories. And so I've plotted the job growth that we saw in each of those major sectors in the U.S. and in Texas in 2022. And you can see that for Texas, our job growth was slightly ahead of the nation at 3.5% versus 3% for the US last year. In some sectors, we did a little bit better. And then there were others where we did see slower employment growth in Texas. Construction, I believe, was one of them where our employment growth lagged what we saw nationally. While in leisure and hospitality and manufacturing and financial activities and in information services, we did see faster growth than the nation experienced. Now, most of these sectors, with the exception of oil and gas, mining, and I believe government, I think most of the others have fully recovered in the sense that whatever jobs were lost during the pandemic, we have recovered all of those jobs, and we have added several thousand more across all of these sectors. So our job growth continues to be not just really robust and strong, but it also continues to be broad-based across the major sectors. Now, Texas adds jobs at a 2% average pace, and that's our annual average rate of growth going back almost 4 decades. So if I take the job growth in each of the years going back all the way to 1990, our average growth rate comes out to about 2% of employment growth. So 3%, at 3.5%, we still did better than what we would do in terms of a typical normal year for growth in Texas. In terms of the metro areas, job growth also was broad-based across our major metropolitan areas across the state. Austin is our perennial leader. It always sort of exceeds job growth in most other metro areas in the state, and that's because its composition sort of lends itself towards a faster pace of growth than DFW and Houston. The other reason also is that Austin is a much, much smaller metro compared to the massive size of DFW and Houston. I mean, DFW is almost 7.9 million people. Houston is a close second. And so given that Austin is less than half the size in terms of population compared to DFW and Houston, their base of workers is a lot lower, and so their growth rates also tend to be faster than what we see up here or in Houston. But overall, 3.4% job growth for DFW last year is quite strong because, like the state, our average pace of growth is just above 2%. So one thing that we are sort of a little bit cognizant of or cautious of or watching is our benchmark revisions. And I know this is a little bit technical, but I just wanted to quickly try to explain what this chart is showing. So there are 2 sets of employment data that the BLS, which is the Bureau of Labor Statistics, which tracks job growth across the nation. They have 2 data sets that they look at for job growth. One is the CES, which is the Current Employment Services Survey, which is a much smaller sample of firms across the state of Texas, which report into that survey on a monthly basis. What they also have is called a quarterly employment survey that they do, which is more of pretty much the full universe of firms in the state. I think almost well over 95% of the firms across the state are captured in that survey. So it's a much, much more robust sample of exactly what's happening, and also includes all the smaller businesses. So it's a much, much better measure. And so what it's done is that the headline number for employment growth that you see on a monthly basis, which is your news flash every month when the employment numbers come out, comes from the CES, which is a smaller sample of firms. And then once every year, The BLS then takes the quarterly numbers that they get from their larger data set, which is kind of a universal set of all firms in the state, and then they benchmark that data to the monthly numbers. And so the Dallas Fed does that on a quarterly basis. The BLS only does that once a year. And so when we benchmark the employment data through June of last year, we did see some significant downward revisions to the headline numbers that were being reported on a monthly basis. So the gray bars represent the unbenchmarked data, the data that we saw what the employment growth was prior to the benchmark. And then the blue bars are telling you what the employment growth actually came out to be after they were matched with that larger data set. And so if you look at the part that is circled, you will see that in the month of April, the employment growth was revised up, but both for May and June, the employment growth numbers were revised down quite significantly. And that sort of is an indication to us that when the BLS does finally benchmark their data in the course of the next, they will benchmark it in the next month, we will likely see the job growth numbers for last year being revised downwards. That means our job growth was not as strong as we actually thought it was when we were going through the course of 2022. So this is something we're kind of watching out for, and we'll have a better sense of what the revision looks like once the BLS releases their numbers in the next month or so. So now turning to sort of broader economic activity and also looking at perhaps a little bit the construction and real estate and the energy sectors. This chart is from our Dallas Fed Texas Business Outlook surveys. And this is a monthly survey that the Dallas Fed conducts where we reach out to about 500 firms across the state of Texas. And we ask them to tell us about a whole bunch of different indicators that they are seeing or that they track for their business. So in the manufacturing sector, we ask about production. Are you producing more than last month, or are you producing less than last month? And for the service firms, with the question we ask them is on revenues, where your revenue is higher. Did they increase over the previous month, or did they stay unchanged, or did they decline? And then based on the responses that we get from this large sample of firms, we put together diffusion indexes, which are plotted on this chart. The blue one is for the manufacturing survey, and then the green one is for the service survey. And anything above 0 means that that sector is growing on net. And a negative number indicates that we're seeing a contraction in activity in that sector. So although both the service sector revenue index and the manufacturing production index remain above 0, you can see the line has been sliding downwards since mid-2021. So we saw a huge rebound in both manufacturing and service sector activity in the first half of 2021 as the economy reopened. And then we slowly saw that pace of growth decelerate in subsequent months. But the pace of growth, even as it was decelerating through through the second half of 2021 and the first half of 2022, it was still well above average. So the pace of growth was slowing from maybe 5% to 4%, but that was still above average for the manufacturing sector and for the service sector. In the last, I would say, 6 months of 2022, including the first month of 2023, because we have data through January of this year, we have seen the pace of growth fall below average, both in the manufacturing sector as well as in the service sector, which tells us that there is a lot less momentum that we see in the economy as we have entered 2023 compared to where we were at the start of 2022. And also as part of this survey, we also ask our manufacturers as well as our service firms about a whole host of different indicators. So one of them is new orders in manufacturing. And this is basically a demand measure for manufacturing because it tells us if new orders tells you how many new orders or new demand for product are these manufacturers seeing. And so manufacturers saw, really enjoyed great demand for their products in the second half of 2020, for all of 2021, and for the first half of 2022. But since June of last year, this index has been negative, and it's been negative for 7 straight months at this point through January of 2023, which is not a very optimistic sign. In fact, it's a sign that is signaling sort of a red flashlight for us, a caution signal for us that something is amiss in the manufacturing sector, because manufacturers are seeing much lower demand for their products now than they were seeing 6-7 months ago. This is also a reflection of a pullback in the construction sector, perhaps to some degree, where we're seeing housing starts fall. And then we're also seeing like slower demand for some other goods as well. So turning a little bit to the construction and real estate sector, this chart is plotting this kind of the statistics in the single family housing market, which many of you are probably familiar with. The green line represents the 30-year fixed mortgage rate. The blue line represents Texas home sales, and the red line represents single family housing permits. And as we have seen, interest rates more than double over the course of last year. We have seen a huge slide and pullback in home sales activity, which has been pretty much in tandem with the increase in mortgage rates. Once the mortgage rate crossed like 4.5%, we started seeing home sales begin to decline. And because of a pullback in demand for homes, builders are reacting quite quickly to that pullback. And as a result, we've seen housing permits also fall quite dramatically in the last 7 months of the year. Even with the pullback in both home sales as well as in permitting activity, sales still remain in line with the levels that we saw in 2019, which was a pretty decent year for home sales activity, not just as great as what we saw in 2020 and 2021, but still by historical standards, the sales in 2019 were pretty solid. And so we're back down to those levels in the market. And similarly, permitting activity also is more so in line with what we saw back in 2019, which again was much higher in terms of permit issuance than what we saw in 2018, 17, and kind of going backwards all the way through 2010. Now, with the pullback in demand for homes and interest rates being much higher, that means affordability is a lot less for consumers. Consumers are being priced out of the market, and as a result, we've seen some pullback and adjustment in home prices as well. This chart is showing you the median home price in the large metropolitan areas of the state, and I've included the US and the Texas numbers as a benchmark to see how we did relative to the nation. Now, Austin, as you can see, the red line, was not only the leader in job growth, but was also the leader in terms of home price appreciation over the course of the last 3 years. Prices went up the fastest in Austin, followed by DFW, and then by the state overall. The growth rates that we saw in Houston and San Antonio were slightly below the appreciation that we saw statewide and also nationally. The figures that you see at the end of the chart are telling you the decline in home prices from the peak. So the peak in home prices was back in summer of 2022. That's when home prices peaked and began trending down. And so in Austin, they're down 9.2% from their peak as of December 2022. In DFW, it's a very modest decline of 3.2%. And nationally, we see a 3.6% decline in home prices, which is not much given that year-over-year home prices were up in the double digits, both in 2021 as well as in the first half of 2022. Also, with the pullback in demand for single-family housing, we're also seeing a pullback in demand for apartment rentals across the state. And I haven't plotted the occupancy numbers, but occupancy also has been coming down after peaking in summer of 2022. It has been slowly inching downwards in all of the major markets in Texas, and also in many of the markets across the US as well. We're also seeing a pullback in rent growth. So this chart is showing you the year-over-year change in rents. So it's a growth rate and not a level. And we're seeing a pullback or a deceleration or a slower pace of rent growth across the United States, including in all major metropolitan areas of Texas. In fact, in the last 3 months of last year, we don't have data for January yet, But in October, November, and December, rents were either flat, there was no change, or they were slightly down from where they were in September of last year. So we are seeing some softness in rental markets as well. Turning to office market, I mean, this has been sort of a head scratcher for many of us. During the course of the pandemic, the expectation was that, as companies reopened back, the economy opened back, we would see an improvement in the office market. But it seems like the office market recovery has happened in fits and starts. 2020 was obviously a very slow year. For office markets, we saw the vacancy rate climb pretty sharply in all of 2020, and we saw continued increases in vacancy also in for most of 2021. We did see some pickup in leasing activity in the office markets in the last, I would say, quarter of 2021 and the first 2 quarters of 2022. But since then, again, we are seeing some softness in the office market, where leasing activity has pulled back because there's a lot of economic uncertainty and employers are not sure if they're keeping their workers or they're letting some of them go. And for that reason, and given where, how the market has changed over the course of the last 2 years, with the emphasis on, on worker flexibility and making sure people can work from home, because it's hard to find the right set of workers with the skills that you're looking for. And so you have to be much more flexible with your employees and allow them to work from home. We have seen, sort of, like I said, much more softness in the office market than what we expected coming out of the pandemic. And the expectation is that 2023 again will sort of be a very modest year for office demand, given how much economic uncertainty there is currently in the market. Turning to the industrial sector, this has been sort of the rock star sector amongst all commercial property types. I think multifamily did quite well as well in 2021, when we saw double-digit rent growth across the board in all markets. But some of that momentum got lost in the second half of 2022. But as far as the industrial sector is concerned, we saw really strong momentum throughout the course of 2022. In fact, the overall absorption for industrial space in 2022 for the major 4 Texas markets exceeded how well they did in 2021. And 2021 in itself was a record year, both for DFW as well as for the Texas industrial markets, in terms of how much product was absorbed. Now, for DFW, 2021 still remains the record year. The absorption here was slightly less, but was just shy of what we saw in 2021. But we did see much more, or more than double, absorption in San Antonio compared to 2021, and a little bit also Houston did slightly better also in 2022 in terms of absorption compared to 2021, which is why we see the Texas bar being higher for last year compared to the year before. Now, the only caveat here is that although industrial markets remain exceptionally strong and we are still seeing a lot of momentum, we are seeing a pullback in the manufacturing sector, which is also a big driver of demand for the industrial sector. So as manufacturers pull back, and that means they probably don't need as much warehousing space, the expectation is that we will probably see moderation in this market as well. The other thing to also keep in mind is the huge amount of construction of square footage of different industrial properties that we are seeing, especially in DFW. DFW has almost 77 million square feet of industrial space under construction currently. And so that is a little bit concerning to see if demand can keep up with the supply that we currently have underway in DFW. So I think last year we absorbed about 30 million plus in square feet of space, industrial space in DFW, and the year before was closer to 37, 39. I don't have the numbers in front of me, but it was close to like 40 million. So But even with that, even with our two best years in terms of absorption in DFW, the 77 million figure is quite high in terms of the total square footage of space being constructed currently, and likely will exceed the demand that we see this year. Now, with the demand being really strong on the industrial side, we've seen those vacancy rates drop quite precipitously in the last couple of years, and most of them are still, even with the huge amount of elevated construction, the really bloated construction pipeline, not just in DFW, but also in Houston to some degree, as well as in Austin and San Antonio, we still are able to maintain our low vacancy rates. But the expectation is that we probably will see some uptick in these through the course of 2023. In terms of the construction, what does the construction overall look like? This chart is plotting the construction contract values for the different types, property types. And you can see the blue line is the residential line, which has obviously turned downward with the pullback in single-family demand for single-family homes, and with permitting activity being down, we're already seeing a pullback in contract values there. We've seen a pullback in non-building activity, which typically tends to be not building, but like it could be road work. I don't have the details in front of me, but it's a combination of like perhaps some structures which are outside of a traditional building. And then we have the non-residential building component, which still remains quite strong and is partly due to the huge amount of industrial construction that we are seeing occur across the state of Texas. In terms of, again, this is a chart where I'm talking about loan volumes. And so like the Texas Business Outlook surveys where I talked about manufacturing and service firms, we also survey our bankers across the state of Texas. And when I say the 11 districts, so the Federal Reserve has 12 district banks. Each bank has its own geographic area. So for the Federal Reserve Bank of Dallas, our geographic area that we keep an eye on is the state of Texas. And then we have a portion of southern New Mexico and northern Louisiana as part of our district. So we track bankers a little bit outside of Texas in those two regions as well, to be able to keep up with what's happening across the banking sector. And this chart is plotting the share of bankers that are seeing an increase in that said that they saw an increase in loan volumes versus the share that said that they saw a decrease in loan volumes. This survey is done about 8 times a year, so it's not monthly, it's done every 6 weeks. But for all, regardless of which type of loans you look at, whether it's commercial real estate, whether it's commercial and industrial loans, whether it's consumer loans or residential real estate, we have seen a pullback in volumes, in loan volumes, which means banking industry has become a lot more tighter in terms of who they are lending to. And they are not only seeing a pullback in demand for loans, but they also are seeing, they themselves have become a lot more stringent, and the guidelines are a little bit more stricter now in terms of lending going forward, given that we're in a higher interest rate environment. The first loan type to turn down was the residential real estate, because I think that was the sector that got hit the first when interest rates began to rise. But during the course of last year, we also saw loan volumes declining in other loan types as well. And then kind of talking a little bit about the energy sector. The reason for putting this chart in is because Texas is the #1 oil and natural gas producer in the nation. And so this is an important sector for Texas per se, maybe not so much for the nation, but for Texas, whenever oil prices are high, they do hurt the consumer, like you and me, because we drive and we have to fill our cars up with gas. And when the price at the pump goes up, that eats into our paychecks. But for the state of Texas, because we are a producer, it's a net benefit for us because the state does get royalty payments. And it does lead to more jobs in the energy sector. So overall, when you weigh the cost versus the benefits, it does benefit Texas when oil prices are higher. So oil prices they're not as high as they were back in mid-2022, We saw a huge spike after the Russia-Ukraine war occurred in February of last year. We saw oil prices spike, go to close to 120, almost touch $120 per barrel, and then they have been trending down since then. They are in the mid 70s right now, which also, is, it's if it's not a positive, it's a neutral benefit for Texas, given where oil prices are currently at. And then, like I was saying, the reason for showing you the rig count is it just tells you how many rigs are actively drilling for oil or natural gas across the state. And if you look at the first part of the chart from 2017 to 2020, you will notice that the rig count moves pretty much in tandem with oil prices. So as go oil prices, so does the rig count. But since the pandemic, since mid of 2022, we've seen a decoupling of both where oil prices are at and versus where the rig count is at. So even with the huge run-up in oil prices, we haven't really seen much of a run-up in the Texas rig count. So oil producers, even with the higher oil prices, even when oil prices were at $120 per barrel, were not drilling as much oil as they could have. And that's there's a whole host of reasons why they've been a lot more hesitant to make investments in oil production. One of them has to be financing. There's a lot more pressure on them, and they have been previously, because oil prices are very volatile. Many companies are hesitant to make investments on moves that happen during the course of a day or a month, because a lot of these rig projects are much more longer term for them. So looking ahead to what we expect for 2023, this is a plot of our employment growth forecast for the state for this year. So here the numbers at the end of each year represent what the job growth was for that year. So in 2014, Texas saw 3.7% job growth. In 2015 and 2016, our job growth was around 1%, 1.3 and 1.2. Then we were back to sort of being in our modest pace of growth from 2017 to 2019, where we saw just above 2% job growth, and 2.1% is our average annual pace of growth. We saw jobs decline 4.4% in 2020. Then we saw 6% job growth, which is 3 times our typical growth in a given year. In 2021, job growth last year was 3.5%, still above our 2% growth rate. And then for this year, we expect job growth to slow down to 1.4%, be more in line with what we saw in 2015 and 2016 when Texas was experiencing the energy bust. Oil prices had collapsed in 2015 and 2016, and that was a big damper for growth in the state. And so we expect job growth this year to slow down and be below average for the state. And this is barring we are not factoring in any recession when we make that 1.4% forecast. So there's a big cone of uncertainty around that number. And so our range forecast is anywhere between 0.5% and 2.3% growth for the state. So if things get better during the course of the year, we could be closer to 2%. But if there is an event which leads to a slowdown big in the U.S. economy, that 1.4% growth rate will be an optimistic forecast. So some kind of concerns I wanted to walk you through that we have been hearing, and we have been able to filter through the comments and the responses that we received from our panel of those 500 firms in the Texas Business Outlook surveys. And so we asked the set of those 500 firms, we asked them what were their top concerns for their outlook as we entered 2023. So we asked the same set of questions back in September, and then we asked them again in December to sort of get a benchmark of how the responses were changing from fall to winter. And in September of last year, about 46% of our respondents said that demand was weaker for their products, and a potential recession was their top concern. Now that category of firms saying that grew from 46% to 54%. So we saw an increase in the number of firms telling us that they expect 2023 to be a slower year. And that was their biggest concern for 2023. The other top concerns included higher labor costs. labor shortages, where 38% of firms said that they expect labor to still be difficult to hire this year. Inflationary pressures, the cost of products being higher was also a concern. And then another concern that has popped up recently is the higher cost of capital for interest rates. So back in September, only 17% of firms said that higher interest rates would be an outlook concern for them. By December, that number had doubled, that share had doubled, and 32% of firms said that that was a growing concern for them. So some of the concerns that we see as growing concerns are the potential recession or weakening demand for firms this year. The other one that grew was the higher cost of labor. And then the third one was the higher cost of capital. Those were the top emerging concerns. The concerns that we saw sort of receding, where less firms were saying that they were concerned about this in December versus September, were labor shortages. And then supply chain disruptions was another one that receded from 31% firms telling us that they expected supply chain disruptions as their top concern, went down to 22%. And then the third receding concern was also inflation. So although firms expect inflation, they expect the rate of growth in prices or their cost to be a little bit less than what they saw in 2022. So this chart is telling you the wage and price growth expectations, again, from that sample of 500 firms that we survey on a monthly basis. So at the end of every year, so in December of every year, we ask the firms to give us their projections of what they expect the average increase in wages to be at their firms, the average increase in costs or input prices, and then the average increase that they expect in selling prices. And so you can see that I've plotted all the responses that we have gotten going back to 2019. So in 2019, when this question was asked, so this question for 2019 was asked in December of 2018. They saw 3.9% increase. They expected 3.9% increase in wages, 3.4% increase in input costs, and 2.4% increase in selling prices. Now, fast forward to 2020, 2021 and 2022 is the two big years where we saw a lot of inflationary pressures. Those responses, as you can see, had doubled. So firms in 2021, they saw their wages increase by 7%. And in 2022, they saw their wages increase by 7.6%. This year, for 2023, their expectation is that wages will grow by 5.6%. So still higher than what it was pre-COVID back in 2019, but less so than what they saw in 2021 and 2022. And the story is pretty similar for input price increases as well as for selling price increases. As you can see, costs increased by almost 10% both in 2021 and 2022 on average for all firms. Their expectation of input cost increases this year is about 5.9%. And then similarly for selling prices went up by more than 7% the previous 2 years, and they expect selling prices to be up by 4.7 or nearly 5% this year. So some reprieve in inflationary pressures, but not to the degree as we would have hoped for 2023. The other thing also to keep in mind is that the ability of firms to pass on these cost increases, whether they be labor costs or they be input costs, like materials that you need, for example, for construction or for making any product. It's getting harder and harder for firms to be able to pass on those increases to their customers because customers are becoming a lot more price sensitive, given that the cost of everything, whether it's gas or groceries or your rent, if you've just bought a home, your mortgage has gone up in the course of the last couple of years. So back in November, only 24% of firms were saying it was easier for them to pass on the higher costs to customer. 40% said that they did not see any change, and 36% said it was much harder for them to pass on these cost increases to their customers. Now, if you compare those numbers to May of 21, which is when we were just starting to see these inflationary pressures come to bay in the market, the responses were a lot different. Back then, 31% of firms said they were able to pass on higher costs to their customer, and only 25% found it harder to do so. So we are seeing that it is becoming more and more difficult for firms to pass on higher costs to their customers. So that's, again, another outlook concern for us in 2023. And then I just wanted to sort of give you a quick update of what construction input costs have looked like. So we all know construction input costs surged during the course of 2020 and 2021, but we have seen them come down some in the last few months, especially in the second half of 2022. The blue line shows you the year-over-year change in the producer price index for construction materials, and the red line is showing you the monthly change. And so during the course of the last few months, the monthly change, I mean, we've not seen net much movement. So prices are still really elevated. I'm not saying they have come down, but we are seeing less price appreciation or less input cost increases in the last few months of the year. We've seen some pullback, a huge pullback in lumber. We're seeing some of the other material costs sort of hold steady, but not all of them have come down. But on average, we are seeing a pullback in input cost pressures in construction as well. And then the last thing I wanted to mention, because I wanted to sort of, before I go to my summary slide, talk a little bit, be more optimistic. Texas has been a big beneficiary of both domestic and international migration. And the reason we're able to grow faster than the nation, and our job growth, like I showed you, was higher last year compared to the nation. We were also one of the first 5 states to recover completely from the pandemic and regain all our lost jobs. On average, we add jobs at double the rate that the nation does in a given year. And we've been able to do that is because our labor markets are a lot more flexible in Texas, and we have this huge influx of migrants, both domestic people moving from other parts of the country to Texas, and also international migration. And in 2020 and 2021, because of the pandemic and through the first half of 2022, we did see a huge pickup in domestic migration to the state. A lot of people were leaving California, Illinois, Chicago, New York, and they were just kind of coming into Texas. We didn't see much movement in international migration until last year, and that's because the borders with Mexico was pretty much shut through most of last year. It just opened in 2022, and so we've seen again a surge in international migration as well, and that has helped boost our labor supply in Texas and helped us grow a little bit faster than the nation on average. And so kind of summarizing all the things I went through, we are seeing signs of slowing spreading across the state. We're seeing, employment, we expect the employment revisions to be mostly downward and not upwards, and which means our job growth, once everything is said and done, will look a lot less positive than it did while we were seeing the headline numbers every month in 2022. We feel that the job growth for 2022 currently is a little bit overstated, and it will be revised downwards. We already are seeing the interest rate sensitive sectors such as housing and also to some degree commercial real estate being hit by those higher rates. We're seeing a pullback in investment activity. We're seeing less assets exchange hands. We're seeing less deals being able to pencil in with the higher rates. The two things that are still a positive for Texas are our energy sector, which still remains and is seeing good growth. And our labor markets are still quite robust, and we still are seeing positive job growth. Our unemployment rate is coming down. Fundamentally, the job market still looks quite strong. We do expect a much slower and below trend year for Texas this year, but then again, there are many, many risks to the downside, which include, the higher inflationary pressures, which have come down but will still remain elevated, the slowing that we're seeing globally across the board, the wage pressures and the labor shortages that firms are experiencing, which have not completely alleviated as of yet. So I'll pause there and see if I have time for taking a few questions.